Welcome back to Fair Fade Investing. Today we're taking a look at Ulta Beauty, ticker symbol ULTA. We've got price per share of $472.57, a market cap of $22.95 billion, and an enterprise value of $24.93 billion. If you've never heard of Ulta, there's 1,355 stores at the end of fiscal 2022 and a partnership with Target. Ulta Beauty is the largest specialized beauty retailer in the U.S. The firm offers makeup, 42% of its 2022 sales, fragrances, skincare, and hair care products, or 21% of their 22 sales, and bath and body items as well. Ulta offers private label products and merchandise from more than 500 vendors. It also offers salon services including hair, makeup, and skin, as well as brow services in all of its stores. Most Ulta stores are approximately 10,000 square feet and are in suburban strip centers. Ulta was founded in 1990 and is based in Bolingbrook, Illinois. So looking at the financials here, first thing I'm seeing is their cash debt ratio is very low. So they have 6 cents for every dollar of debt they have. So not exactly an optimal position. When we look at their profitability, we see gross margins, operating margins, net margins, free cash flow margins, all fairly steady. A lot of green versus the industry, and then versus history. For example, their current gross margins are at 39, just below their maximum for the last 10 years. Operating margins 14.85, so above the median and below the maximum, on the upper end of the last 10 years. For net margins, currently 11.37, just below their 10-year maximum. And free cash flow sitting just about the average for the last 10 years. These give me some insight into how the business is doing, but for management strength, I use return on equity, return on assets, return on invested capital, and return on capital. For all those stats, it looks like it's beating the industry. And versus history, a 62% ROE is seriously strong. 23% return on assets, above their median, just below their maximum. Return on invested capital, 31, between their median and their maximum for the last 10 years. Return on capital at 46%, so above their median. Fairly strong numbers for management strength, and fairly strong margins in relation to the company's history as well as to the industry. Looking at the price to earnings ratio, their current is 19.17, with a median of 29 and a minimum of 12.18 in the last 10 years. A fairly low price to earnings ratio in relation to the last 10 years. With trailing 12-month revenues of just about $11 billion and a current market cap of about $23 billion, the company is trading for roughly 2 times their trailing 12-month revenues. When we look down here at the annual financial data, we can see that revenue is increasing over time pretty steadily. We had a dip here in 2021 for the first quarter earning results, and then back to the trend thereafter. We can see that net income is growing over time as those revenues are increasing. When we look at cash debt, we can see the debt really appeared for this business in 2020 and has stuck around since. Switching to trailing 12-month, we can see that trend of revenues increasing and net income gradually growing. We can see this cash to debt. The cash is decreasing while the debt remains about the same or even spikes up a bit. We see share buybacks Pretty significant share buybacks, although it does make me wonder why they're buying back shares when they could be paying down their debts, but that's some management preference. When we look at their operating revenue by business segment, we see that cosmetics is 42% of the business, hair care and products follows at 21%, skincare is sitting at 17%, fragrance and bath is 14%, their services represent 3%, and 3% for accessories and others. So the majority of this business is in their cosmetics, hair care, and skincare, as well as fragrance. Another thing we see here is that by geographic region, the United States represents the entirety of their revenues. If this company were to expand to Europe, for example, or Canada, we could see increased revenues in expansion. But to get a closer analysis and see what's currently priced in, let's run a DCF. So in the DCF here, we see 4-star business predictability. We have data for the 10-year, 5-year, and 3-year annual rates for earnings per share. And for free cash flow as well, we have 10-year, 5-year, and 3-year data. So starting with earnings per share, based on our 10-year annual rates of growth of about 20%, we see that the fair value should be closer to 773, whereas currently we're at 472. To see what's currently priced in, we'll lower this down. So currently there's between 12 and 13% growth priced in for earnings per share for the next 10 years to equal our fair value of what it's roughly worth today. So with a growth rate of 13%, that's lower than their 10-year past returns, lower than their 5 years, lower than their 3 years. So if they can continue what they have done for the last 10 years, then it would be worth that previous number of roughly 700. If they can achieve this 5-year return for the next 10, then a fair value would be closer to 591. And with what appears to be accelerating growth in the last 3 years, then growing at about a fast pace of 24 would leave them at $1,000 roughly. So again, 20, which is their 10-year earnings per share, would leave them at 773, and closer to 16, or their 5-year earnings per share annual rate, would leave them closer to 591 for fair value. Currently, there is between 12 and 13% earnings per share growth priced in. But switching to free cash flow, we see here their free cash flow for the last 10 years has grown at about 40% a year. And in the last 5 years, it's dropped to 26% annually. In the last 3, even slower to 17.8. So currently for free cash flow, it looks like there's about 18.5 to 19% priced in for the next 10 years to equal what we're currently at today. If you think they can re-accelerate their free cash flow growth to 20, then there's some margin of safety. If you think they can grow it to 25%, then again we get that 700 fair value. Although 25% growth is a significant amount of growth for free cash flow, it's possible even 20% is a strong amount of free cash flow. If they were to match their 10-year returns, then obviously there'd be a significant amount of upside. But even 20% would be a fairly strong number for this company to achieve. Slightly outpacing the last 3-year average. If they were to drop down to, for example, 15, then fair value would be closer to 369. But all in all, this is my assessment and hypothetical framework for Ulta stock. If you have questions, leave a comment below. If you want a company reviewed, drop a ticker. Let me know in the comments. Leave a like, subscribe. See you next time.